Hey guys and girls, today I'm going to talk about how to analyze a good investment property. And properties come in all different shapes and sizes. Your opinion to a property might be different to my opinion. Everyone has got an opinion. There's 10 million properties or whatever in Australia. People make money every day on property. People lose money more than they make money. I've been a part of over 20,000 real estate transactions. And over that time, I reckon 70% of the properties that I have bought have sold for cheaper to us than what some other poor bastard paid for them 10 years prior or 5 years prior. Does that mean the deal's bad? Well, they've all gone up and doubled and tripled. And I actually think the growth has been far greater because of the dynamics and the metrics of what I've been looking at when analysing and securing those properties. So looking at the deals, 20,000 deals that I would have done, and then let's say, I don't know, I send a deal to 2, 3, 4 people when they make a decision on buying the property. I could have sent out 60, 70, 80, 100,000 properties over the last 2 decades to people. And when those people are buying those properties, not everyone said it. So why did those people miss out on a deal? What was the misinterpretation from what I see to what they see? And what means a good investment caliber and investment grade stock to me? And it could be very different to you. So, things I want to look at are cash flow, growth potential, equity, rebuild price, there's migration comes in, which I don't talk about that often, but it's very important. And the other one is serviceability of the people. So let's break down each one and what I mean by that, and then we can go from there. So cash flow, it must be neutral to positive. And if it isn't, I want to know why. I have bought negative cash flow properties beforehand, and it might be something that's negative $50 per week. So it's only $2,500 a year. But then the upside is if I push rent by $100 and it goes to the positive anyway. Or it could be there's negative $50 if I'm pulling out $200K in equity, so I can use that to go buy more properties. So neutral cash flow, neutral positive where we need to be at. Growth potential. I'll look at what it has as potential. I don't care what it's done. Everyone's like, I'll tell you where people get screwed up in a minute, right? I'm going to scrap this side of the screen and I'll show you where people get screwed on. Over there. So growth potential. I don't care what it's done previously. I don't care what it's done 10 years ago. I don't care about what. I only care about what's the potential based on other metrics that are coming into the market. That's very important. So if it doesn't have growth potential, I don't really want the deal. The equity. If I'm buying an asset, I want to know that I'm going to be able to go back in a month's time, 6 months' time, 12 months' time, and be able to pull out my capital. And if I'm not, it might be that I'm buying something that's positive. I don't know. Let's say I'll buy something positive $500 a week, but it might be a block of units that costs, I don't know, $700K, and it might be harder to pull the equity, but you've already got 10 properties. So where does it fit in that journey? So that's actually another very good point, is your strategy. Because people have, there's deals to be made, but is it the right deal for you? So for example, if we're going from Sydney to Perth, you go on the plane, but the plane isn't going to get you from your house to Perth. You're going to need to hop in a bus, a train, an Uber, taxi, whatever to get there. There's no point hopping into if you had an opportunity for a train, a bus, and an Uber and a plane, If you take the plane from your house to the airport, it's going to be really hard to do that. And you get to the airport and you're like, okay, I have to drive the car now that I'm at the airport. People stuff up their strategy because they've got the wrong vehicle at the wrong time. It doesn't mean that any of them are a bad vehicle. You need them all on your journey, but it's just the structuring of it is wrong. So very important is, where does the deal fit into your strategy? Rebuild. So if I'm buying a property for, say, 300K, any property today in Australia for 300 grand, it's pretty hard to even build a granny flat for 200 grand today. So if I'm buying an established house or an established unit or an established villa or townhouse, and I'm getting it below rebuild cost, I know that any competitor that has to come in the market, let's say I'm buying a property for 300, but it's going to cost 600 grand to put a build plus the land plus the DAs plus the developers profit, all that, then that means any new stock coming in the market is going to have to be at this level, right? That's being conservative. Where can you buy a brand new property in 2025 for 600,000? It's pretty hard out there, but let's assume you did. That means that everything else in the market would get dragged to that level, or the market would have to go up before this becomes profitable for the developer to come out and build more stock. So if it's below rebuild cost, very, very good fundamentals there. Migration. So you go to a country town, you go to where, let's just use a country town because it's isolated, right? But someone's in a little town, how can you double the population like that? How can you put the pressure in the system? You know, in a town of 10,000 people, you can't put the pressure in the system for it to double overnight, but you can with migration. You can in a capital city like Sydney or Melbourne or Brisbane or Perth. We're seeing it happening and unfolding in front of us at the moment. So migration is very important. And I've actually looked at some data in some of the most exclusive and expensive areas of Sydney, and look at the growth and the percentage of growth there. And it's pretty hard for those things to go up and double and triple and quadruple. But some of these other areas, they can double, triple and quadruple within a year or 2 years. And what is the contributing factor is that there's much more migration going into that area. And the last one is serviceability of the market, right? So if we've got a property for $2 million and the house, you want to see it double to 4 mil, but the income of people is 100K each, so you got 200 grand household income, 200 grand's hardly going to be able to keep it afloat at $2 million. For it to double, that means the average household income needs to double as well. But if we're buying a property for 300K and the average income's 100 grand as a household income, that means that property could possibly go up to a 700 grand level without any pushback. Quite comfortably it could go up to that. So all of these things are very, very crucial when buying a property, to going, okay, that's important for when I'm taking that decision. Now let's go to the side where people make mistakes. I called screwed before, but let's call it mistakes. So what are the mistakes? People want to go for a house. People want to have land. People want to subdivide. People want a nice area. People want it close to home. People want it new. People want, let's just leave it at that, right? So when I'm looking at a property, I've never once talked about a house, a unit, a land, or whatever. I'm calling it a property, right? Even up here, I'll put the property just naturally because I want the asset. I'm focused on the asset. I'm looking at the cash flow. I'm looking at the logistical side of it. People say, I want a house. Why do you want a house? Oh, because the house will go up more. Well, I can show you 15,000, 20,000 examples. I'm just going to use 15,000, saying that's like a 70% version of a unit going up over the 5,000 houses, where the units go up greater than the houses go up, right? Just because they're house or land doesn't mean it's going to go up any greater. For example, I've got these houses in the Gold Coast that I paid 500 grand a piece for. fabulous, right? Development potential, maybe put units, townhouses on it, whatever. Potential, maybe, hopefully, one day is the words that I'm using here, right? But reality of it is those properties, those houses that I bought for 500 grand are now worth $1,100,000 if I'm lucky. So they've doubled, right? And here I am, I hate them, right? Why do I hate them for? I don't hate them. Hate's a very distasteful word, right? But they're not that great, right? People go, oh, what? Your house got up from 500 to $1 million. It's doubled. You should be happy, right? Well, I bought the things for 500 grand. Let's use a little example here. 500K. They're now worth $1 million. It's a weird way of putting a mil as 1,000K, but anyway. But they were renting out for $500 per week beforehand. They're now renting for $650 a week. So now these properties are becoming neutral cash flow, where they were negative cash flow beforehand. But at the same time I bought these houses, I was buying units for 170K, and they were renting for $350 a week. They were neutral cash flow before. Now these units are worth $600K a piece, and the rent is $550 a week. So now these are positive $200 a week or $10K a year. They haven't bled me for all this time. The price has tripled in value. And the reality of it is that these works that I need to do on these units is next to nothing. But I'll tell you, in these houses, I've had squatters, I've had gutters, I've had roofs, I've had all different. I've spent hundreds of thousands of dollars on these shitty houses in a row to keep them, some of them are brick, some of them fibro, whatever. I've got fibro houses that are perfectly fine as well. I've got, all different types of properties. But in that example, I could have bought 3 of these units from 170 to get to 500. The cash flow would have been neutral to positive from day one. It'd be now positive for those 3 would be positive 30,000 a year, not 10,000 not just breaking even right now. But 3 times 600 would be 1.8 million instead of the $1 million that they're worth. So when I look at it, it's the house that was moving the chessboard. Oh, did I forget? People go, oh, strata's bad or whatever. Well, you got to pay building insurance on a house where the strata covers the building insurance there. When you look at the land tax is minimized. So, be cautious. Are houses good investments? There's lots of good houses out there, right? However, when people are looking for the house, they're leaving money over there. So what is your goal? Is your goal to say, I've got a house added to my portfolio? Or is the goal to say, hey, I've increased my revenue across my total portfolio by $500 a week, and I've added, my net worth position has gone up by another 200 grand. What is the end goal? That's what you need to be focused on, which takes you back to that strategy point that I made down there. Land can be good, but land can bring land taxes. Land can bring expenses. Land doesn't bring a cash flow. I personally have large land holdings. I've got hundreds of thousands of square meters in the Sydney district. I've got heaps of land that could be used as development sites, like that one I just used it as an example. I do have heaps of land tax, and most of my problems come from these 2 things. But anyway, subdividable, people looking at that. What is your goal as an investor? Is it to become a developer? People go, okay, I bought a house for $1 million. I can chop the block in half, and now they're worth $650 a piece. So you've made $300K. Right? That might take you a year to do. There's expenses for in and out. If you're going to build a dwelling on them, and say they're worth 1.1 mil each, which sounds good, but then you've got to spend another $400,000 on the build. That means they're probably worth more selling them just as a block of land. It's probably worth more selling them as a block of land rather than doing the build and selling them as a house and land package. So I'll look at what am I going to net out of doing that result. But then ultimately, you go, I bought it for $1 million. I sold it for 2.2. I spent 800 on it. You made 400 grand. agent fees, holding costs, stress, all that sort of shit, but has locked you out of the market for a period of a year or 2 years whilst you've done this project, and everything else in the market has gone up as well. And if you want to go and buy any other sort of properties, you're going to be paying more for that. So it's the opportunity cost of your capital and your servicing and your position. You need to focus on that and go, okay, well, if I move this chess piece over there, how's it going to affect me in the longer term? Because I see so many people that do these things. They buy, they build, they subdivide, they do this, they do that. And they might make a few $100,000 here and there. But if they had just bought something and held on to it, they would have been far greater off from doing that. I've seen it happen so many times. So people try and do that, they get themselves screwed. It's got to be in a nice area. It's got to be near where I live, right? People live all across this country. One of my biggest regrets, I was looking at buying in 2003, before the internet was out on your phone or whatever, for realestate.com, I heard about Logan in Brisbane, and I went up there on a holiday with a girlfriend I was dating at the time, and I didn't buy houses and units in Logan for 50 to 60 grand a piece. And Sydney market had boomed. Oh, here's another one. It goes off the back of that. Sydney market had boomed and it peaked in 2003. The market went backwards. And I thought to myself, well, Queensland's not good. Units and villas and townhouses are no good. I can't renovate it or do the work on it myself because I'm not near it. And I didn't buy the properties. Sydney market crashed between 2003 to 2007. Probably 30 to 40% of the value of the properties dropped in Sydney. A lot of you probably don't even remember that. But it happened. So Sydney crashed, right? But Queensland, those little 60 grand things in Logan went up to $240,000 a piece. So they went up 4 times. And I realized at that point that my opinions don't pay my bills. It doesn't matter if it's not if it's a house. It doesn't matter if it's not where I am. It doesn't matter about me doing a reno to it. I realized at that point, I'm not a tradie. I don't want to be a tradie. I'll get people to do the renovations. My thing is I need to make the capital growth on the deal when I'm acquiring the asset. So, yeah, being in a nice area, being where you're from, whatever. Let me tell you, I've got some beautiful properties. I've got properties that are worth 10 mil a piece. I've got properties in amazing locations. There's all waterfront properties, right? But some of the best returns that I've seen have been from the ones that are in the most shittest, remotest, dodgiest areas. My portfolio is very diverse, right? It covers every element of the rainbow, right? But my nice ones, I've had terrible tenants in nice areas. I've had family areas which are $2 million houses, which attract druggos and different things that occurred. So it doesn't make a difference. The last one is new. People go buy new, and it's like buying the brand new car and taking off the lot. When you're buying a brand new property, I'm just going to clear this up a little bit. When you're buying a brand new property, the developer is making all this money, and you're paying a premium. I said beforehand, about 70% of the properties that I've bought in the last 20,000 transactions that I've done are cheaper than what they were 10 years ago. And out of that 70, I'd say half of them would have been new properties that sold, and they were sold at a price where they fell. So when you're buying a new property, expect to lose money. You're buying a chunk of shit. It looks new, it's nice, it's whatever, but you're paying a premium. It's not a good investment grade stock. Generally, the person that's selling it to you, they're not a buyer's agent. They go, oh, I'm an investment advisor, whatever. They're getting like a $50,000 or an $80,000 commission in the back pocket for selling that thing to you. So just be very, very, very diligent on that front. So when I'm looking at the deals, I'm looking at the logics of it. I'm looking at the strategy. I'm looking at how the property is going to fit in, and what is that property going to do to get me further on the portfolio. There's so many properties. Cut that bit out. There's so many good properties out there in the marketplace. I wish I could buy them all, right? Blocks of units, shopping centers, everything, right? But is it, what do I need for the next leg of my journey? And is that the right decision that I should be taking? And how does it fit in? I remember I got stuck. I was buying only houses to start off with, and I got stuck on my 7th property, and I couldn't get to my 8th property. I wanted to buy a house on land in Tregear. It was a house on land in Tregear in Sydney. It was a 190k. It was a bank repo deal. 190k. It was just before Christmas. One of the agents that I work with, he was like, "Oh, this thing's fantastic. It's worth 250." I'm like, I could just flip that thing, right? And I thought, yeah, it's cool. I'm going to ask the bank if I can get it. Went to the bank and it rent for, say, $200 a week at the time. 2-story, 5-bedroom house. And the bank said no, right? I was like, oh, shit. So I didn't buy it. And then I found a unit for 140k and rents for $170 a week. I said, can I get that one? The bank said, yep, you can go buy that unit. So 140k for the unit. And then another one came up in the block for 130k. I said, can I get this one? Being a smart ass. It rents for 170 a week. I think it was maybe 180 a week or something at the time. And they said, yep, you can buy that. And I went back and I said, you lied to me, right? You said I couldn't get the loan, but I just got 130 and I got 140, so I got 270k, but you wouldn't give me a loan for the 200 grand property. Why is that? You lied to me. Stop talking crap. And they said, no, this is the bank. Said, no, you see, yeah, you've got 270k, but your income has gone up more significantly. And it wasn't until that point in my journey that I got stuck at my 7th, 8th property. I thought to myself, shit, it isn't what I want. It's what the bank needs from me. I need to present myself to the bank so they'll keep my journey happening. So if you're going to retire on one property, then great. But I haven't seen any successful investor retire with one property. They need 5, 10, 15, however many they need in their portfolio. So you need to make yourself attractive to the bank for them to give you the funding so to be able to afford it. So when I'm looking at analysing a deal, it's not just, hey, has this got good growth or whatever the case may be. If I'm just using data, and I see so many people out there today just going, oh, I'm using AI, I'm using data, the analytics of it, whatever. Yeah, that's cool. You need to see what's happening in the markets and look at all the data inputs. But that data is incredibly skewed to or against what you're wanting to do. The data would look terrible on 9.5 out of 10 of the properties that I buy because you would have looked at 10 years ago, it's cheap or whatever. Here's the thing, right? I said I was going to come back to this it's a very good closing point, right? This is where I look at all these people now, they're like, oh, buyer's agent, data-driven technology, whatever, right? And I actually think they're using all my data out there, which is kind of funny, right? They go to Perth. You buy a property in Perth for 200k. And then it goes to 300k. And then everyone starts coming into that market and buying these things at 300 grand because they're like, hey, it's gone up by 50% in a year. It's a great buy, right? So then all the people come in and they start buying at 300 and it goes to 400. And everyone's like, shit, over 2 years, it's doubled in value. And then more people go, well, the data is showing this is a fantastic hotspot. Let's come in. And they go from 400 to 600k, right? So there's gone, it's tripled in value. Right? It's gone from 200 to 300 to 400 to 600. This thing's tremendous. And you got all the people out there using all their data and all their technology and all of this stuff and it's saying this is a screaming buy. If you look at all the data, it's showing it's on a trajectory all the way up to the moon in a rocket ship, right? The reality of it is when you're looking in Perth today and the houses are 700k, I bought them for 200 grand less than 5 years ago, 4 years ago, 3 years ago, 2 years ago, right? They've got all the way up to that. It's tripled in value. What's the chance that it can go from 700k to $1.4 million? It doesn't service for the people in the area. The migration there, the rebuild, now it's becoming more than the rebuild value. The equity's not in the deal because it's too hard to get the equity out. The growth potential, the growth has already been had. So the problem is that could it go up to 1.4 or could it go back down to 500k? Where's the greater chance, right? Because it doesn't go up forever like this. It doesn't matter what state, country, territory, whatever. Bitcoin doesn't even go up straight through the moon, right? It goes up and down and up and down. So why would I want to buy anything at the top of a market cycle? It's fucking beyond me. right? So I'm using Perth as an example. We could take Perth off here and so Perth and change it with Townsville. We could change it to Gladstone, right? Let's buy a house for 100 grand in Gladstone. Now everyone's going, oh, it's a great buy, $500,000. Yeah, wait another 5 years, right? Let's see what happens to that data then for you. So be very, very cautious of how all that information fits into the property, the selection, and making that decision. And is it the right thing for you? Is it the right vehicle for the day for you? Do you need something for more cash flow? Do you need something for more equity? I look at that, I'm like, there's so much scribble there. But hopefully you've learned something, you've looked at something differently. If you need help on working out your strategy or finding the properties, running a scenario past us, hit us up 1300 367 925 or admin@binvested.com.au. Thanks for watching. Have a great day. Bye for now.